Let's welcome in Collin Martin, the Director and Fixed Income Strategist at the Schwab Center for Financial Research. Collin, thanks so much for joining us this afternoon. First, I want to kick things off talking about the Fed. We've been talking about them all day. We know they kick off their meeting tomorrow. What are your expectations coming out of this meeting?
Well, we're not expecting any change to Fed policy. That's basically priced in right now, where there's a near zero chance of any movement in the Fed funds rate, whether up or down. But this meeting is accompanied by an updated summary of economic projections. So we'll get an idea of where various Fed officials see the economy evolving over the next handful of quarters and years, and then what that means for their actual Fed policy projections, the so-called dot plot. What will be really interesting is how the inflation outlook has changed, if at all. Because if we go back to the last time we got an updated summary of economic projections, because inflation remained sticky at the time, the median projection for the year-end core inflation rate was revised higher. But what we've seen over the past few months is that it seems like the disinflationary trend has resumed. So it's going to be really interesting to see how those play out, and if they end up revising lower their inflation expectations, and therefore what that means for the path going forward.
So summary of economic projections, very important, and of course, constantly talking about the dot plot. Explain the importance of the dot plot, because I think it's the less discussed thing that everyone's focusing on right now, but obviously a paramount importance.
The dot plot's very important, but we always like to highlight that a lot can change over time. It's not a forecast from Fed officials. It's basically the projection based on where each official sees or expects the economy to be at a given point in time down the road. So you have to look at both the economic projections and the dots in concert with each other, because it's those economic projections that therefore result in what the Fed officials expect how restrictive or accommodative Fed policy to be at a given point in time down the road. Now, if we go back to the March meeting, we saw a pretty tight dispersion of where Fed officials saw rates being at the end of this year, at the end of 2025, where the median projection suggested 2 rate cuts by year end. But there were 4 officials who were expecting or were projecting no rate cuts, and 4 officials who were projecting just 1. So there was a pretty large number who weren't seeing an urgency to do anything, or if they were seeing, basing their expectation on what they would do, a pretty minimal cut. So it'll be interesting to see if the number of cuts gets revised down a little bit from a medium standpoint, and if the median dot projects just 1 cut by year end. I'm not sure it'll change too much, because as it stands in the here and now, we've started to see somewhat of a slowing in the labor market. Nothing that's too concerning just yet, but the pace of job growth and job gains has slowed. But more importantly, on the inflation aspect of the Fed's dual mandate, there's been a lot of concerns about what the tariffs might mean for inflation going forward. But what we've seen so far is that services disinflation might actually offset that. And that's not necessarily a good thing. That means slower consumer demand and maybe potentially slower growth down the road.
So you mentioned the inflation piece of the Fed's dual mandate. How do you think right now the inflation piece is comparing with the employment piece? And is the Fed weighing one more heavily than the other?
You know, right now, I wouldn't say they're weighing either more heavily than the other, because if you look at both independently, neither necessarily suggests the Fed should be doing anything. If we look at the labor market, for example, we've seen an increase in the unemployment rate from the lows of 2023 and 2024. We were as low as 3.5% or so. Now we're back up to 4.2%. I think that's a key reason why the Fed ended up cutting rates by 100 basis points last year, because of that weakening in the labor market. But over the past 12 months, the unemployment rate has traded in a very, very tight range. It's been between 4% and 4.2% for 12 straight months. So that suggests that Fed policy is probably in a good place right there. Fed doesn't need to do anything. If you look at inflation, it's come down off the highs, but then it kind of leveled off for a little bit. And we saw inflation readings in the 2.5% to 3% for most inflation indicators. That also suggested that the Fed was probably right in backing off in their policy last year and cutting rates. But because we've held steady, it makes the case that they should probably hold rates where they are for the time being. Now the question is what happens over the next handful of months, because the disinflationary trend that I mentioned before, it seems to be back. And if we look at core CPI, for example, we've had in 3 of the last 4 months a monthly reading of 0.2% or less. And if you look at that on an annualized basis, the Fed's at target. So I think they're going to be, debating whether or not they see cracks in the labor market forming or not. And if inflation is at their target on a 3-month annualized basis, are rates too high right now? So it's going to be really interesting to see how the projections come out, and specifically comments from Fed Chair Powell.
Well, we will have those answers in 48 hours. Thank you so much, Collin. We appreciate your time. Again, that's Collin Martin, the director and fixed income strategist at the Schwab Center for Financial Research.